In this video, traders, let's talk about why signal does not always equal trigger. Stick around. Hey traders, warm welcome to you. All right, so sometimes, and maybe I should have put does not always equal, the signal bar does not always equal the trigger bar. What does this actually mean? So interestingly, an interview with Al Brooks, and something Al Brooks said very similar to this is like, hey, listen, sometimes you get a signal, that doesn't necessarily mean you have to pull the trigger. This is very similar to my approach where I use a filters and triggers type thing. So we send a signal and a trigger, and it's kind of from a bar perspective. For me, I like to look at the filters that come in and say, hey, that trade has passed through my filters. Now, it doesn't necessarily mean a trade. I need an additional trigger to take that trade. A filter might be, hey, we're up 300 points on the day, we're above the overnight high, we are coming into kind of lunchtime, and the trigger might be an engulfing bear candle, for example, right? I need those multiple things to kind of combine. And so Al said something similar, the signal doesn't equal trigger. I don't think it's telling this exact words and paraphrasing a touch, but this is the point, right? So many traders operate from this perspective of, hey, I need to see X, Y, Z, and then I also need to see A, B, C to pull the trigger. I might see X, Y, Z, but if I don't see A, B, C, I'm not going to take the trade. All right, so what does it mean and why should we think about this? I think for many traders, and probably myself included to a certain extent in my early career, maybe 15 years ago or so, I would see something that I'd identified as a signal and take it. And that was almost as I was too early, I was too late, the positioning of the trade, the structure of the trade wasn't quite right. It just never seemed to work. But actually when I took it a step further and I said I did the filters and triggers type thing, I said, okay, this is what I want to see and this is the trigger, and very precise about the signal I wanted to see after the boxes were ticked, then that became a much more easier way to trade. So example might be this, right? You say, okay, listen, maybe this bearish engulfing bar here, let's call this bar 1, has formed. Now, sometimes you might say, right, I want to take that on the close, right? I want to take a short on the close. Imagine there's the VWAP running along here. Let's say that's your volume weighted average price, if I can spell. Let's get rid of that. Let's make that a little bit cleaner. There we go. Not the best chart in the world, but you get the point. Number 1. Bar there. Now that might be your trigger and signal. So it's not always, but that might be. But you may say, hey, you know what? It's still an uptrend just because it's got one kind of bearish bar engulfing and outside bar. Yeah, but my trigger bar might well be something more like it tries to come up, takes out the high and sort of forms that sort of bar. That might be your trigger bar, but again, you wouldn't just take that on its own, but maybe if you're taking it, hey, there's your signal. Now, if it's followed by a bar with a high wick or a bar that takes out the high that fails or whatever it may be, and you can adjust it to suit your own trading, that then bar number 2 becomes your trigger bar. So sometimes I think that when you think about trading in that manner, it's like, okay, what's the signal, what's the filter, and then what's the trigger? And when you're looking at these two things and you have a distinct separation, it becomes a little bit easier and cleaner. And when you look at candlestick patterns, you say, okay, that's fine, but is there a bar that actually says, right, I want to take it on this? Or is there something I need to see that's extra? And some might call it confirmation. Yes, perhaps you could call it that. But I think it's more from a charting perspective where you're saying, right, that's a very clear signal to me. That has done something, but that doesn't necessarily mean that's the trade I want to take. And it could be the structure of the trade, right? Imagine you've got this sort of market's doing that, and then you get a big green bar and you want to kind of buy that breakout. You want to buy that strength. You may not want to buy here. This is maybe your signal bar because where do you put your stop? Again, you say, well, actually, what I want to do is that's my signal, but my trigger is going to be the first red. I buy on the first red. So maybe the next one is green as well. Maybe the next one is green as well. Then you get a little red here. Okay, there's your first, and you're buying on the close of that, for example. And this was the signal bar way before, but you're waiting for that first unwinding to buy the trade. Right, you're not buying straight away on there because you can't structure a trade, whereas here you can maybe put the stop under there. Yes, it's high, yes, it's a worse price, so to speak, but actually the trade's structured far more cleanly and has a better way of looking at it. It's the same as the kind of first pullback to a moving average type trade. You might have the same type of scenario here. You might say, hey, that good drive, those 3 good bars there is the signal, but I'm not buying at the top of this. No way, because where to put my stop? My trigger is actually if the price comes down and touches that. That's making it a little bit broader, but you get the idea. market. You have something that, yes, I want to get along this market, or I'd like to get along this market, but under these conditions. So you then become a very strict trader. You say, hey, I allocate my capital when I choose to. I like this momentum, I like its reversal, I think it's going lower, or I think it's going higher, but I also want to see this. That's my signal. I also still want to see now my trigger, which allows me to pull the trigger and take the trade. So the signal's there, looks all great, but that's not enough, because as traders, it's not just our job to predict direction. You might be able to, that's okay for the guys on TV saying, oh, I think mine's going lower and higher, and maybe okay for hedge funds who are okay to sit through, drawdown and what have you, because they're looking at a 10-year cycle or a 5-year cycle. As short-term traders, we are looking to capitalize and use capital as a tool, right? So we may say, hey, this market's going way higher. I can just see it is. And we feel that, but the danger we have is we go in, and when we're trading leverage, we can get stopped out on the right idea. So we need that extra idea, extra kind of trigger to say, hey, that looks like the actual good structure to place to trade. That makes a sensible place for the stop. That's this, that's that. Let me trade in that manner, and let me use that as a tool to leverage into the trade, to allow me to use margin, to limit my losses going against me, and to maximize the profits going in my favor. So I think that's a good way of looking at it, guys. Either filters and triggers perspective, or saying, hey, the signal isn't equal to trigger. What do I need? Sometimes it does. Sometimes it does, but most of the time it doesn't. Worth giving some thought to your own setups and strategies. Yeah, see you next one, guys. Bye-bye.